things kicked off here. So hi there. Thank you for joining us for our last Teen Youth Month Financial Training Ground pop-up. My name is Jen, and this is Lynette with me today, and we work for Horizon Credit Union. Just a quick note that everyone has been muted and cameras are turned off. So please feel free to use the chat to ask any questions that may come up as we are going along here, or to participate if you would like. So you'll notice it's a little bit interactive today. We'll get to make some decisions and some choices together and see where that takes us. So here we go. So in today's workshop, we will learn what a credit score is, what impacts our score, and how credit can impact different financial decisions that we make or different financial options that we might have. We'll determine how to use credit effectively, and we'll become familiar with student loans and how those work. We'll also learn about the pros and cons of buy now and pay later. So imagine with me here, you may have to close your eyes, but your life in 10 years. What do you imagine your life looking like? Do you maybe have a job? Are you successful, living on your own in an apartment or your own home? Maybe you have a roommate, or again, have your own home already. What does a typical weekend or weekday look like for you? So this part's kind of fun. Just visualize there for a minute. We'll keep on going. And we'll move into why credit matters. So credit is going to impact that vision that you have of yourself in ways like having your own cell phone plan. It'll provide you the ability to do that. It'll provide you the ability to rent that apartment for yourself. To buy that car that you want and have saved up for. It'll help you to get credit cards, which will help you to increase your credit score if you handle those well. Purchase car insurance. They're often going to check your credit score when you get insurance. So also buying a house, of course, they're going to take into factor your credit when doing that. And then also taking out student loans. So something that might be a little bit closer in the future for you there. And what is a credit score? So a credit score predicts how likely you are to pay back a loan on time. A scoring model uses information from your credit report to create a credit score for you. Credit scores are going to range from about 300 to 850, and the higher the score, the better. So you want it to be as high as possible. Another thing that I relate a credit score to, or even a credit report, is kind of like an adult responsibility card. We're seeing how responsible you are with paying back money that you borrow and that kind of thing. So super, super important, because when you want to borrow money again in the future, they're going to look at how you've handled that in the past. And then some companies or some organizations that might check your credit score would include utility companies. Oftentimes there'll be big down payments or things like that if you don't have good credit, even just to sign up for utilities. Cell phone providers are going to look at that credit score. Landlords are definitely going to look at that credit score before they rent to you. They want to know if you're going to pay that rent each month. Very important to them. Credit card companies, of course, they're going to look at that. If you are looking for credit from any organization, credit card, they're going to look at that credit score. They want to see how you've handled that debt in the past. And then car insurance providers can also look at your credit score, and that can factor into what you pay. So believe it or not, it has a lot of impact on a lot of different areas. Even in some cases, when you apply for a job, they will check your credit. So just can't stress enough how important it is to take good care of that from an early age. So let's take a look at a scenario. We've got Liam and Jacob, and Liam and Jacob both apply to get a credit card from the same credit card company. Financially, the only difference between them is their credit score. Liam gets a credit card with an annual interest rate of 10%. Ouch, that still seems kind of painful. And Jacob gets a credit card with an annual interest rate of 25%. Oh, goodness. So who do you think has the better credit score? Jacob, Liam, or do you think they have the same credit score? Or do you think we don't have the ability to know? Are credit scores random? After everything we just went through, I think we know the answer to that one. But feel free to pop in the chat your guess or your educated answer, and I would love to hear that from you. So who do you think has the higher credit score? Or better credit score? It is definitely going to be Liam. Liam with his 10%, although that may seem high to some folks, is much better than Jacob's 25%. So I would say in this situation, it's probably pretty easy to guess that Liam has got that better score. And yep, see, we were right. So factors that impact your credit score. If you consistently pay your bills on time, that's going to help your credit score. Credit utilization ratio, and that sounds kind of fancy and kind of confusing, but again, that's just how much of your available credit that you're using. Your length of credit history. So if you start early and take good care of that credit, that will help. Mix of different credit types. So installment loans, revolving lines of credit, that kind of thing. So a car payment would be a good example of an installment loan. A credit card would be a good example of a revolving line. So that mix of credit is going to help with your score. And then also new credit applications. That won't necessarily help your score. It's going to impact your score for sure, but you want to stay away from applying for too many new credit applications, especially all at once, because that's going to send a red flag that you're having some kind of major financial issue. And anytime you apply for new credit, it does ding your score a little bit. So something to keep in mind. And next we'll talk about what is a good credit score. So what credit score range qualifies as poor? Well, 300 to 579. Fair would be considered 580 to 669. And a lot of folks fall right into these categories too. So don't feel bad if you're starting out somewhere in the poor or fair range. Good would be 670 through 739. Very good would be 740 through 799. And then exceptional would be anything above 800 up to that 850 cap there. So that's kind of the rules of the game there. And now you can see where you lie and see how you can progress to improve your credit score.
So let's look at some credit score takeaways. Your credit score is a number, as Jen just talked about, between 300 and 850. So if you have a low credit score, you may have fewer options for different services or may pay more. And I think Jen kind of mentioned that earlier too, you know, like your landlord, your insurance, you know, you might pay more if you have a bad credit score. So you don't want to pay more on your insurance. You want to save money. So, and then paying bills on time is a simple way to help boost your credit score as well. So we're going to look at what credit cards are and how they work. So they act like a short-term loan that allows you to make purchases, and you must pay all money from your purchases back. So if you pay off the amount you spend or borrowed before your billing date, you don't have to pay any interest on that money that you borrowed. And then anything you don't pay off will accrue interest. And it's also a type of unsecured debt. So some potential benefits of credit cards is it can build your credit history. And then you have the ability to maybe make some larger purchases. And it also has some protection for you, you know, like for fraud and things like that on your account. But some of those potential risks are spending money that you don't have. So, you know, you might put too much on there, you know, charge too much on your account, and then you're not able to pay it off each month. And then you'll be paying more interest. Again, you'll accumulate more debt, and it could hurt your credit score because you want to keep those balances on those cards low. So we'll look at another scenario. So Liam has a higher credit score. So he received a credit card with an interest rate of 10%. Jacob had a lower credit score. So he received a credit score with an interest rate of 25%. Liam and Jacob both used their credit cards to make $1,000 purchase. And you guys can go ahead and answer this if you want. Go ahead and put it in the chat. So if Liam pays off his credit card in full before the billing date, how much will his $1,000 purchase have cost him? Any guesses on that? So we'll look at the next question too. So if Jacob pays off his credit card in full before the billing date, how much will his $1,000 purchase have cost him? And we'll give everybody a minute to answer on that too, if you want.
I'm throwing my guesses into the chat there. I guess A on both of them.
That's correct. Yep, they are both $1,000 because they paid it off before interest accrued. So they paid it off before the next billing date. Good job, Jen.
Thank you.
You're welcome. So if we want to look at the power of compounding interest, and this graph is so interesting to me. It really puts into perspective the differences with $500 with 3 different interest rates. So it just shows the importance of, what you'll end up paying if you have bad credit versus what you'll end up paying if you have good credit. So if you look at the top, well, let's look at the bottom one. So the bottom one shows that you'll pay a lot less for the same amount of money versus the middle one. So the bottom one, you'll pay 0% interest. The middle line graph there shows that it's 10% interest. And then the top one is 25% interest. And I think if you hover over them, it shows what you end up paying over that amount of time.
Oh, I'm not having any luck with the hovering there.
It's not doing that. Okay. Huh. I think, okay, so we'll keep going. So let's look at another scenario. So Liam has a higher credit score, so he received a credit card with an interest rate of 10%. Jacob had a lower credit score, so he received a credit score with an interest rate of 25%. Liam and Jacob both used their credit cards to make a $1,000 purchase. Sounds kind of familiar. So Liam has an interest rate of 10%. He makes only the minimum payment on his credit card, which is 2.5% of his balance. Interest accrues every single month, including on the original amount and on all the previously accrued interest, aka compounding interest. How much will Liam's $1,000 purchase have cost him, including interest, by the time he pays off the bill? Any guesses there?
I'm afraid to throw anything out on that one, but please feel free. Anybody in the chat that is bold enough for that one. I need a calculator. I'm sorry.
Yeah, I know, exactly. So the answer is D. He'll pay $1,332.88. That's insane to me. So let's look at the next one. So Jacob has an interest rate of 25%. He makes only the minimum payment on his credit card, which is 2.5% of his balance. Interest accrues every month, so the same as the last scenario, including on the original amount and on the previously accrued interest, the compounding interest. And then again, how much will Jacob's $1,000 purchase have cost him, including interest, by the time he pays it off? Any guesses on this one? Which answer is correct? The number D. Yeah, that $3,700 or $3,703.42. No thanks.
Stop here really quick while we're on this topic, but that minimum payment, just be careful. It's referred to oftentimes as the minimum payment trap, because you will pay off that minimum payment for so long and you'll pay so much more in interest. So just be aware. Always try to pay more than the minimum payment if you can.
Good advice, Jen.
Thank you.
So now we're going to look at debit cards and prepaid debit cards, kind of the difference, the pros and cons with those. So with a debit card, it's a card that's linked to your checking account that pulls money directly from that account. So the pros with that is that you're not borrowing any money. The cons are typically it has less fraud protection with those cards, and they don't have the rewards with them are not as good as like a credit card would be. And then it doesn't build any credit history. So then if you look at a prepaid debit card, it's a card that's not linked to any checking account, and instead it's loaded with funds. So however much money you have on it, that's the money that you can charge against that card. So you can't spend more than what you should be spending, I guess, is a good way of looking at that. So the pros, like I just said, you can't overspend, and it comes with some protections, limited, but some protections. And then the cons are, it does not build any of your credit history. It's not accepted by all merchants, and often it comes with more fees than a typical debit card would. And then there's some limitations that may apply, such as no access to mobile banking on ATMs.
Absolutely. So we're going to look at another situation here. We've got Michael. So Michael has a credit card, but finds himself overspending regularly on non-essential purchases. He also has trouble making his monthly payments and pays late more often than not. Ooh, scares me about his credit score. Michael enjoys the convenience of a credit card, though, and he would prefer not to go back to using only cash. So which of the following options do you think would be the best solution for Michael? A, should he keep on using his credit card since he can get those rewards points? B, should he keep on using his credit card since it's convenient? C, maybe he should consider using a debit card since it can make overspending more difficult and offers much of the same convenience as a credit card. Or D, should he consider a debit card because it offers better fraud protection than a credit card? So if we were paying close attention on Lynette's last slide there, I don't see anything coming through the chat, so I'm gonna go ahead and throw out. Thank you.
Sorry, Jen, didn't mean to interrupt you, but I'm gonna throw out C. The answer C, I think, is what it is.
I like it. That's where my head was at too. Absolutely correct. So definitely C, should consider a debit card since it can make overspending more difficult, and it does offer much of that same convenience that he's looking for from a credit card. May not offer quite that same fraud protection, but does offer the convenience for him and would definitely help reduce his overspending. Next up, we've got Naomi, and Naomi usually only uses cash, but wants to build her credit history and improve her credit score. Naomi is good with money and plans to pay her credit card off in full every month, but she's worried about the high interest rates that come with credit cards. So which of the following is the best option for Naomi? A, should Naomi get a credit card and pay it off in full each month since interest only accrues when you do not make payments in full? I like where that one's headed, guys. I'm going to throw it out there. B, should Naomi get a credit card because rewards points always make up for the interest that you would pay? C, should Naomi get a debit card to build her credit score? That face should help with that one. D, Naomi, should she get a prepaid debit card to help build her credit score? Anybody want to venture a guess? Oh, I see one in the chat. Get a secured credit card. That is excellent advice. I appreciate that, James. Absolutely. That would be an excellent option for her. In this case, though, best option that we have is A, she should get a credit card or secured credit card and pay it off in full each month, since interest is only accrued when you do not make those payments in full. So people often refer to credit as free money, and it's kind of is, but only if you pay it off each month. You can't be paying those interest charges or else it's not free. And then credit card takeaways. So some things to think about, and hopefully that you learned here today. Credit cards impact your credit score, and paying on time helps your score, while paying late definitely hurts it. Credit card interest is compounding, which means that it can add up to a lot over time. Compounding, what that means is that once you've accrued interest in past months, in future months, you're going to be charged interest on the amount that you charged, the balance, and then the interest that was added to it, so that it compounds on each other. That's why it's called compounding interest. In dividends, compounding interest is a great thing, but in loans, compounding interest is not so much fun. So you're paying interest on interest, really. And then if possible, pay the full statement balance each month to avoid paying any interest charges, or as little in interest as you can. And then if you cannot pay the balance in full, prioritize paying off the balance as soon as you can. Avoid making only the minimum payment unless it is absolutely necessary. Like I said, that minimum payment trap will get you caught up for so long, and you'll end up spending so much more money in interest. I've seen it, I've lived it, so please learn from my mistakes. And then what are student loans? So a type of loans to help cover the cost of higher education. we kind of all know about student loans over the last year. We've heard a lot in the news about those probably. But they have comparatively low interest rates, typically come with a more flexible repayment term than other types of debt, at least, like taking out a personal loan or something like that to pay for school. They're easier to qualify for than most other types of loans as well. Oh, and I see, oh, we have a question in the chat. Does I'm assuming Horizon Credit Union offer a secured credit card? Yes, we definitely do. We offer a secured credit card. And then got another one in the chat there. How long does it take for your credit score to go back up if you mess it up? Well, that kind of depends. There's no like hard and fast rule for that. You would have to start making different choices than you did to get your credit score messed up. But it does take some time. It's not going to happen overnight. I'm not going to make any promise like that. Paying your bills on time, number one thing you can do to improve your credit score. But it will take a little bit of time, and don't despair. Keep plugging away at it, but it definitely is possible to come back from messing that up. I'm a prime example. So,
Me too.
also, thank you. I'm not alone. I appreciate it.
No, not alone.
Throw myself under the bus. But yes, so student loans. Let me get back on track here. I apologize, but thank you for the great questions. I appreciate those. Easier to qualify for than most other types of loans, like we said. Student loans are also often considered a good debt. A mortgage is another example of that. But because it's kind of an investment in your future, because your increased earning potential is typically more than the loan will be. So like your lifetime earning potential, it's probably going to take like one of your chunks of annual income out, I'm assuming, for student loan balance usually. But yeah, over the lifetime of your working career, it is definitely going to be less that you could earn, or more that you could earn because of that degree. So something to keep in mind. Those good debts, hard to believe, but not all debt is bad. And then Jasmine and Lily. So another scenario here, we've got Jasmine and Lily. They're both seniors in high school, and Jasmine wants to go to college and earn her bachelor's degree. Since she cannot afford to pay for the tuition outright, she takes out a student loan. Including interest, the loan will cost Jasmine $75,000. Lily also cannot afford to pay for tuition outright, but taking out a loan for tens of thousands of dollars seems like too much money to her. Lily decides that she would rather not go to college since it would require her to take out a loan and go into debt. Believe it or not, this is one that I hear very, very commonly. I was actually just with a group of high school teachers last week, and this was one thing they were saying too, is that students automatically assume any debt is bad, but not always the case. So let's look a little further here. So how much can Lily expect to earn over the entire course of her life with only a high school degree? And this is obviously not going to be true in all cases. There are definitely people that can be very successful without a college degree, but just one example here of good debt. And then how much the average high school graduate earns. So this is, again, not specific, but this is just an average number. Anybody want to throw it out? So with just a high school degree, how much do you think you would earn over your career lifetime? Not seeing anything in the chat. All right, I'm gonna keep on going here. And then I think it's gonna give us both answers. So we're just gonna ask the next question too. So how much can Jasmine expect to earn over the course of her entire working career with her bachelor's degree? So this is gonna give us the average of how much a bachelor's degree holder will earn. So you'll see the difference there is pretty substantial, over $1 million. So definitely something to think about. But that's what they mean by investing in that good debt. It's going to kind of hedge your bets and give you a financial advantage in the future, even though it may be debt now. So again, like I said, a mortgage is a great example too. Home values usually appreciate. So you're taking on a debt now, but that's going to be worth more in the future. So, and then student loans and your credit score. So student loans impact on credit score. Paying student loans on time will help to increase your credit score. Like we said, paying anything on time is the best thing you can do to increase your credit score. Paying late will certainly hurt your credit score. And then if you have trouble making your payment, you may have options for lowering or pausing your monthly payment. I believe this is called a deferment. I'm pretty certain, or something along those lines. but this can help you to avoid negatively impacting your credit score. So very, very important if you've run into a situation where you're not able to make that, reach out to your creditors or your student loan holders and see if you can kind of lower that interest rate or pause those payments. And student loan takeaways. So student loans are good debt if the loan plus interest is less than your increased earning potential. Student loans often have more flexible repayment options than other loan types. And then paying your student loans on time can improve your credit score, while paying late will lower your credit score. So you have the option to improve it with those or to lower it. Just all depends on how you handle them.
So let's look at buy now, pay later. And see how it lets you make a purchase, but pay for it through a series of installations, only the first of which is typically due at checkout. So the pros of these buy now, pay later are some plans come with no interest and credit score information is not required as it typically is with a credit card. The cons of this, though, is due to its convenience, it may encourage overspending, and some plans come with interest or late fees. And then typically, they do not help you build your credit score or allow you to earn rewards like a credit card would. And late payments or failing to make payments could negatively impact your credit score.
I hate to interrupt here, but I actually just learned myself last week that these buy now, pay later is a huge issue for students and youth. And I had no idea. So very interesting. Thank you for sharing this information, Lynette. Very important.
I haven't utilized it and I don't think I will. I don't know.
No, I haven't either. But yeah, I learned that that is a big problem for students and especially kiddos that are just 18-year-olds that are just getting out into the credit world. So yeah, I had no idea, but this is great information to share for sure.
It is something to be aware of. So let's, different scenarios that we'll look at. Part one maybe is that Aretha has a low credit score and cannot get a credit card. She needs new running shoes for her upcoming track and field season. So Aretha cannot afford to pay for the shoes in full now, but she'll earn enough in her next 2 paychecks to pay for them. The shoes she needs have a buy now, pay later option. Do you guys think this is a good way for her to purchase those shoes? Go ahead and pop your answer in the chat if you want. I don't see any
Go ahead
yet.
and just say verbally, I don't think she should do it.
So the correct answer would be yes, as long as she makes her future payments on time. That's kind of interesting, but I'm with you, Jen. Maybe not. Maybe it depends on where she's at in her stage of life.
Right. Well, yeah. And as long as she makes the payments on time, I suppose not a bad idea, as long as there's no extra fees.
Exactly. So we'll look at another scenario. So while online shopping, Rosa found a pair of pants that she absolutely loves. They're $100, which she can't afford, but there's a buy now, pay later option that would allow her to buy the pants while paying only $25 today, which she can't afford. She doesn't know where she would get the money for the future payments, but she figures she'll think of something. Do we think this is a good buy now, pay later option for her? Yes, no? Go ahead and drop it in the chat. Your thoughts?
I'm throwing out a definitely no, but just because I don't see anything in the chat yet.
So I'm going to throw out a definite no too. I believe the answer is B. No, the pants are not an essential purchase, and she has no plan for covering the future payments. And that kind of goes back to what you were talking about earlier, Jen, that that these are getting a lot of students in trouble because they don't know how they're going to pay for it later.
Right. Have that initial small investment and it's like, I'll come up with something. And when you don't, boy.
Exactly. So the buy now, pay later takeaways for essential purchases, they can help you break up the payment into more manageable chunks without costing you more in interest and with easier approval than credits or, a loan. So that's true. But when not used thoughtfully, they could encourage purchases you cannot afford, when they could cost you more in interest or late fees and could negatively impact your credit score, which we know that that's not a good thing. And then buy now, pay later can be a great option for essential purchases, but it's typically best avoided if the purchase is not essential, or if you don't have the ability to, pay for it in full at that time, or even later if you don't have a plan to do it. So that's our takeaway on that. So today we learned what a credit score is and why it matters, how to use credit effectively, how student loans can impact your credit, and the pros and cons of the buy now and pay later option. So continue your financial journey today and explore the Horizon Credit Union Financial Training Ground for free with interactive guides and videos on a variety of financial topics. And you can go and see us at HZCU.org. Thank you so much for coming today, you guys. Have a terrific day.
And also through the end of the month, you can stop by any branch and to grab your free Youth Month swag. So we have some phone pockets and some piggy banks. So please feel free to stop by a branch, make a deposit, open an account. And I also see we have some questions in the chat, Miss Lynette. So don't
Yes, we do.
So 3 of them, it looks like, from James. Now that medical collection debt will no longer be included in credit reports and scores, how has this affected acceptance, tier levels, ratings, fair, good, etc.? And so that's the first question. And you know what? I honestly don't have a great answer for that, unfortunately. I was not aware that medical collection debt would not be included. When I was married, my husband actually had quite a bit of that. So that was a big factor in his credit score. But yeah, I don't know how that will. I mean, I assume that those tier levels are still going to remain the same as far as the credit score, like the brackets between for fair, good, exceptional, that kind of thing. I would just assume that if you are personally affected by medical debt or medical collections, that your credit score is probably going to see a boost if that's not factored in, would be my assumption there. And then number 2, has this change affected pricing a loan rated? I'm not quite sure I'm understanding that one. But I don't do lending here at Horizon Credit Union, so I would not be a great person to ask on loan pricing or loan rates. You can always check hzcu.org for most current up-to-date rates. Would definitely recommend that. And then number 3, you mentioned, can you send me the link to apply for a secured credit card at Credit Union? Let me go ahead and reach out to a branch staff member and see if they can go ahead and reach out to you, just because, like I said, I don't do that personally here. I do the financial education and community engagement. So I will definitely, and that medical collections ruling came into effect in April of 2023. So very recent here. Yeah, absolutely. So I will definitely reach out to a branch staff member and see if they can go ahead and verify that they can send you that information and get in touch with you, James. Thank you very, very much for your questions today, folks. And thank you so much for attending. We hope that you found this valuable, and we will see you. Gosh, this is our last Youth Month one. So we will see you next month towards the end of May for After Grad Worker College and Student Loans 101. Thank you, folks.
Perfect.
Oh,
Thank you, everyone.
Bye-bye.
Bye.